Shane Oliver, Head of Investment and Strategy and Chief Economist with AMP Capital Partners, joins us from Sydney with a quick take on global markets. Shane, good morning and thank you for joining us. The corporate earnings from US have been robust so far. Jobless claims have been moderate and indices are now at a record high. In these euphoric times when interest rates are being maintained at record low, is there a risk of sharp correction possibly from the Fed action?
There certainly is a risk of a correction at some point, and I think through the course of this year, the remainder of the correction, and it's probably going to be generated by worries the Fed might bring forward interest rates. Stronger economic data, for example, then that will lead to more talk of Fed interest rate hikes when that might occur, and that could give us that correction. But the broad picture to me still looks okay for global shares. Share markets certainly aren't expensive. We don't see euphoric, although confidence measures have gone up. They're not at euphoric levels that we often see at market tops. And whichever way you cut it, the Fed probably won't be rushing to raise interest rates even when they do move. I think it's probably still a year or so away before they actually move. So my feeling is, yes, we will have corrections. Yes, there could be a bit of volatility, but I think the broad trend in markets probably will remain higher.
Shane, the geopolitical developments are also keeping equities on their toes. A worsening situation in Ukraine can spook not just equities but even oil and other commodities. How should one deal with this volatility?
No doubt that the Ukraine situation remains fairly tense. There was some hope a week or so ago that maybe there'd be a diplomatic solution, but there's obviously been a setback on that front over the last few days. So that remains a threat to markets. My feeling, though, in this environment is that investors probably should maintain an overweight exposure to equity markets, but maybe not as much as they had, say, 12 months or so ago, because markets aren't as cheap as they were 12 months ago. So it's still an environment that favours growth assets, favours shares, but just not as much as the case as there was 12 months ago. And I would then be using any dips in markets that might be triggered, for example, out of an escalation regarding Ukraine as a buying opportunity to top up that exposure. In terms of commodities, I think it's a mixed bag. Commodity story, I think, is a messier one. Yes, there is a case to be overweight oil and agricultural commodities and maybe some industrial commodities like copper. But generally, I'd play it on a case-by-case basis rather than having a general overweight to commodities.
Well, Asian currencies are looking a bit wobbly as dollar gains strength. Do you see more pressure building up for emerging market currencies? And what is your call on the rupee?
I think the reality is that the worries about emerging market currencies haven't gone away. They've gone into abeyance, if you like, because it's become clear that the Fed is still a fair way away from raising interest rates. But as we go through the second half of the year, I think there'll be more and more talk about when the Fed will start raising interest rates as the tapering process comes to an end. And that, in turn, I think will see renewed pressure on emerging market currencies. And that includes the Indian currency. The rupee, I think, will remain or will resume its downtrend over the course of the next 6 to 9 months as more talk emerges about when the Fed will start raising interest rates.
So within the Asian region, Shane, we've seen a fair bit of, country churn. India and Indonesian markets have attracted strong flows. Is the Indian market now looking fairly valued at these levels? How much more upside do you see from the current juncture?
I think the upside for the Indian share market is pretty much constrained. I must admit that Indian shares have surprised me over the last few months, making it to near record highs, despite the worries about poor growth and relatively high inflation. So there's certainly been a surprise element there. But of course, what's happened, of course, is the hopes that the potential change of government following the election result, that will lead to a new round of economic reform. And that's, I think, what's driven the Indian share market higher. My feeling, though, is that it's going to be a long, hard slog for the new government. Therefore, I think that the upside for Indian shares in the short term is somewhat limited. Valuations put the Indian share market as being somewhat expensively valued compared to the rest of Asia, and therefore I think there's probably better opportunities, for example, in Chinese shares, Korean shares, rather than Indian shares at the moment.
Well, macros of India are not in best of the shape. Inflation, especially consumer inflation, is still at a worrying level. while industrial production remains sluggish. So the key question is that what can the next government do to turn around Indian economy? Because for the moment it appears difficult that they really would be able to swing things around in the short term.
I think the reality is that the next government in India will face a tough time. The inflation growth sort of trade-off is certainly not as favourable as it once was. We saw a round of reforms going back a decade or so in India. Unfortunately, though, the current government has sort of gone a bit slack on those reforms, and that's led to a situation where the potential growth rate in India has slipped to much lower levels, and the inflation rate is sort of pushed up to relatively high levels. So that's certainly not a great situation to be in. What's needed is a new round of economic reforms, but the new government, even if they start introducing them, won't see the benefit from those reforms for a few years down the track. So I think the next government will face a difficult slog, and it will take a while, even if they do act quickly, before the benefits of reform start to be seen.
So Shane, any sectors that you're bullish on or would want to avoid on the other hand?
I think in the case of the Indian share market, I tend to favour industrial stocks, stocks that will benefit from hopefully an eventual pickup in cyclical growth in India, and also stocks that might benefit from continued growth recovery globally. So I tend to favour the industrials, be a bit sceptical about some of the resources stocks and some of the financial stocks.
And what is your outlook for the Q4 earnings season for corporate India, which currently is on?
I think the earnings results this reporting season, it's going to be a difficult reporting season. Reliance will probably do okay, but the reality is that in an environment of sluggish economic growth, subdued consumer demand and rising interest costs and relatively high inflation, that profit growth is going to be somewhat subdued compared to what might have been the case over the last few years. So overall, I think the report's probably okay, but probably not enough to justify or support the share market at these sorts of levels.